Greetings from our team at Robare and Jones Wealth Management. This is Jack Jones, the managing partner, with our July monthly market update. Before I begin, I want to thank our clients for the trust and confidence that you place in us. The very best part of our day is time spent directly serving you. So we'll jump right in. We hope to see many of you. We're expecting over 100 to attend our quarterly investment forum a little bit late this year based on scheduling. But we look forward to seeing many of you in a little bit over a week on August 12th at our quarterly investment forum at Perry's. We want to remind you of a reframe. This was from a couple of months ago in honor of John Mark, a way of describing in a little bit more fun way headwinds and tailwinds of the market in the phrase of mirth and woe. Meaning the good stuff, tailwinds that are supportive of markets, and woe meaning the bad things that are pushing against markets or otherwise known as a headwind. So we'll talk about all of those as we summarize today's thoughts. So a lot going on. We'll jump right into it. First of all, as it relates to kind of the first half of the year, we had the best quarter in stock since Q2 of 20. And if we look at 1 year performance after good quarterly periods, they tend to be supportive of the next 12 months. So again, Q2, the best quarter since Q2 of 2020. The Mag 7 isn't so magnificent so far this year, at least through mid-year. You'll see only one of the Mag 7 companies is beating the S&P 500 with significant declines from both Microsoft and Meta, which we'll spend a little bit of time on next because they just had earnings out. Microsoft is an example of really green everywhere. The markets really liked these results. And in the early afternoon of July 30th, Microsoft's trading up 17%. So a lot of the decline that we looked at in this prior slide has been erased just in a single day with really good quarterly results. Meta's results weren't bad, but the market really didn't like it. So same trading day period of time, Meta dropped 9%. So there's been some kind of rotation away from, with only one so far Mag 7 company beating the S&P 500. A little shine has come off of some of those names. As it relates to profits and revenue, Q1 growth 29% year over year, and revenues rose by 12%. So overall, that was really supportive. And as we pivot to Q2, continue to be supportive overall. You'll see earnings growth for Q2 has surged to just under 38%, the highest profit growth pace for the index since Q3 of 2021. And as it relates to this kind of AI period versus the dot-com bubble that burst, we've shown this slide a lot, but it really speaks to the fact that during the tech bubble, price really got away from the fundamentals of earnings to a something like 6-to-1 level. Today, we're almost seeing the reverse of that. We actually have earnings growth outpacing stock return. So far anyway, while earnings are strong, they seem to be supporting what's happened so far in the stock returns. And one of the interesting things, it's really is hard to believe, is that on a PE basis, even though the markets are up year to date, the PE ratio is lower than we were at the beginning of this year. And that's because earnings have been so good. Another thing that we're not talking about every day as it relates to financial markets is a lower geopolitical risk environment, which we think the market's pricing that way. And there's some big ifs associated with lower geopolitical risk. If some version of the ceasefire, which is really, there isn't a ceasefire at present, but negotiated deals, straight mostly open, closer to the end than the beginning. If all of these things are moving in the right direction, the market is priced in a lower forward geopolitical risk. There are other things to keep an eye on: inflation, Fed cuts, sentiment. We'll talk about those in just a second. Consumer sentiment is at an all-time low, which is, again, really interesting. That hasn't found its way into hard data, meaning Consumers are still spending at a pretty an aggressive rate. And one of the contraindicators in markets is if we look at 1 year returns after historic lows and sentiment, it also tends to be pretty supportive overall. So sentiment being low is kind of a contraindicator for stocks. The U.S. economy, we'll talk about jobs in just a second, remains pretty strong. 2.5% is the most recent read on the overall economy. And the most recent jobs, while down from the prior month, up 57,000. We are in a midterm election year, and that tends to be lower than all years, presidential election and non-election years, so the odd years. So that tends to be lower overall. Um, but one of the things about election years is that the growth all tends to be kind of in that last quarter. Again, midterm years tend to be lower, but the back half of the year tends to be better, specifically in the fourth quarter. As it relates to where we are in terms of expansion, 73 months in, and an expansion that started in April of 2020. The average expansion since 1982 has been 104 months. The average since going back to 1927 is more like 61 months. So if you're looking at 100 years, the expansion seems pretty kind of long dated. If you look at expansion since 1982, they've been longer. So 73 months of expansion isn't that long compared to 1982 and the average expansion. Bull markets were up about 111% since the bull market began, compared to an average of 192 with the average bull market, and a length of 5.6 years, so 5.5 years, versus we're at 44 months today. So the Fed made some news in terms of what they didn't do, which is the Fed paused. We did pick up 3 dissenters in the most recent vote. So 3 wanted a quarter-point hike. What's interesting is literally while the Fed was giving a press conference, the 30-year was trading at above 5.2. So the long end of the market that's traded is kind of flashing a different signal than the Fed staying neutral on rates. So that's something to keep an eye on. Again, the jobs report down from May, but still pretty supportive overall at 57,000 jobs added. We got a -1 month CPI in June and a year-over-year at 3.5. So the June negative was good. Still a long way, though, from the Fed's target of 2%. We're sitting on a record amount of cash, so just under 8 trillion as of April of this year. What this shows is over periods of time where money market rates have peaked, it's tended to be supportive of stocks going forward. So as we kind of summarize mirth and woe, the good stuff and the bad stuff as it relates to financial markets, we're going to repeat some of what we've said before with new data. The kind of the bull case, the mirth, the tailwind case of what could go right is oil prices fall or stay at a current level. Inflation cools, again, a good print in June with the negative CPI number. On a monthly basis, the AI supercharges productivity and profits remain strong. So kind of the bear case, the woe or headwind case is higher interest rates. Again, the Fed paused, but the 30-year is now trading at above 5.2. The consumers weaken. So not just kind of soft wage growth and weak confidence, but you actually see hard data that may result from consumer sentiment. So that's something to keep an eye on, and that there's a spending slowdown. That's something to keep an eye on as well. So none of these things are a replacement to contact us directly about how all of this impacts you. So please reach out to us. We're here to serve you. And again, we hope to see many of you at our quarterly investment forum on Wednesday, August the 12th, where we'll unpack all of these things in more detail. So with that in mind, we'll close. Again, we wish you and your families well. We look forward to seeing hopefully many of you in August at our quarterly investment forum. Until we see you again, be well and take care.